What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring all of you this evening. So what we're going to be covering in this update is a little bit of the technicals that we're seeing right now on AMC after this pretty significant green day that we had, up about 6.87% today during market hours. We also have to touch on and expand on something that we talked about in yesterday's video, those 1.5 million cancellations to streaming services such as Netflix and Disney Plus over in the UK. And right now, Netflix just reported their earnings. They're down about 24%. That doesn't sound like the reaction that a company or a market would have if the streaming business was going to be taking over the next best thing and killing off movie theaters. So we also have to kind of go over the Ortex data that we're seeing on both AMC and GME, the options chain data, the max pain. But what I also kind of want to touch on in this video is a data point that I've been looking at, and it's average days on loan. Now, we're going to go into a little bit more what this exactly means, but remember what we've been talking about for a while, that it's not necessarily the hedge funds that are really doing all of this nonsense to the overall market, specifically AMC and GME. It's more so the prime brokers and the market makers. The prime brokers are really allowing a lot of this nonsense to happen, and the market makers are really kind of causing a lot of this to happen. So we're going to be taking a look at some of this data that we're looking at here, and it really suggests right now that a lot of these institutions that, like a hedge fund, are not really shorting a lot of shares of AMC right now, but there are very specific ways as to how the market maker is doing this, and that's where we should be focusing our attention to. So before we get into all of that information, if you enjoy the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. And again, guys, if you do want a little free access trial period into the 1348 Discord with me, TMI, and Review Dork, you're about to get that proprietary trading algorithm. Time is running out. We're not going to be doing one of these free trials again anytime soon. So if you do want access to that, make sure you check out that link down below in the description. So AMC closed the day today at $18.68, up $1.20. Pretty solid day today. GME also had a pretty solid day as well. But remember from yesterday's video over here, the streaming pandemic boom is officially over. British households canceled more than 1.5 million subscriptions to services, including Netflix and Disney Plus. And when we come over here and take a look at Netflix, they're down 23.15% right now after their earnings at the current time that I'm recording. You see this narrative portrayed a whole lot in the media that movie theaters are dead, streaming is taking over. But that doesn't necessarily get reflected in a lot of these companies' earnings right now. And the market is definitely not reacting positively to the numbers that these companies are putting out. Now, when we take a look at some of the technicals specific to AMC, specifically the 4-hour, this is kind of the precursor to that daily that we've been talking about a lot as well. We were talking about these 13 EMA tests where it touches here, makes a new low, touches here, makes another new low, touch, low, then it comes back up above the 13, then it came back down. But today we saw a little bit of resistance. It got rejected at this 48 EMA on the 4-hour. If we can climb up and recapture that 200 EMA on this 4-hour time frame, which is currently at about $19.46, that's going to be a very, very strong sign for a reversal back to the upside. So make sure you guys keep a lookout for that. Now, just going over some of the quick Ortex data over here, we've got still 100% utilization, which doesn't make a whole lot of sense. We have 132 million shares on loan, 19.47% estimated short interest, 2.05% average cost to borrow, 2.34% max on AMC. Now, when we come over to GameStop over here, they still have relatively good data as well. We have 100% utilization, which again, doesn't make a whole lot of sense where the cost to borrow is currently at. 8% average cost to borrow, 9.26% max, 20.03% estimated short interest. So, and again, when we come over to the options chain here, we actually saw a nice little flip today. Let me see if I can refresh this a little bit to see if these numbers have changed. Not really. 18,000 calls in the money right now, 11,000 puts. So we saw a little bit of a flip. Yesterday, we saw more puts in the money than calls, which again, when we were trading far enough below max pain, the market makers are going to be really forced to come out and delta hedge, meaning go out in short in order to hedge that the options that they were selling. But now we've seen that kind of flip. Now, is this enough to really have a significant gamma squeeze this week? No, but it does provide a little bit of a backdrop of buying pressure that we could see going into the end of this week. But again, remember what we were talking about yesterday, all of those different Fed speakers and economic data really starting to kind of pick up tomorrow and Thursday. We're going to get Powell on Thursday, and that's kind of going to be the conclusion of a lot of those things that we're looking at over there. Now, max pain. A lot of people have been talking about max pain a lot. Right now, we're seeing the max pain on AMC at $18.50. So this is the price where the most amount of options are expiring worthless or out of the money on either side, puts and calls. So this is going to be hurting options buyers, again, mostly retail investors. Now, let's kind of get into this kind of situation that I was looking at here today on the stream that kind of seems a bit interesting. So what we're looking at here is average days on loan. Now, when you look at these trends of average days on loan, we've used this in the past to kind of determine when the shorts are piling into the stock in order to push it down. Because when the average days on loan is going down, it means a lot more shares are going out on loan from the prime brokers to a fund, an institution that is going to use them to try and push the price down. But what we've seen recently is a massive upsurge in the average days on loan. It is currently 94.3 days. That's the average age of a share on loan right now for AMC, meaning that the actual short activity and the shares on loan activity of AMC going out on loan right now is relatively low. So it would suggest, according to some of these data points, that some of these funds are not really the ones pushing it down. And this kind of goes along what we've kind of been theorizing about and hypothesizing about for a long time, that it's the market makers and the prime brokers' fault, and the hedge funds may not have any idea that they are naked shorting. Some of them might, but the vast majority of them most likely do not, and they are still paying that cost to borrow on those shares on loan. So if this is kind of suggesting that, well, these funds aren't necessarily the ones that are pushing the price down right now, well, what exactly are we seeing? Well, there's a couple of different explanations for this. One is this right here. When we come over and take a look at some of the off-exchange data, remember, we know that anytime an order is going to go in one of these off-exchange venues, an internalizer, Citadel Connect, a dark pool, anywhere that's essentially not on the exchange, it's going to mess with price discovery, meaning that you're not seeing that, quote, true price of what the price should be trading at for AMC. So this is one of the ways that this could be occurring. There's a very easy fix for this. If you don't want your orders going into the dark pool, all you have to do is directly route it to an exchange. You can do those on brokers like TD Ameritrade, E-Trade. I believe Fidelity allows it as well. There are options for you if you do not want your order going into one of these off-exchange venues. The other thing, though, which I think some people are actually going to like, some people may not like, anytime we've brought up institutional ownership changes in the past, a lot of people have kind of said, well, those institutions are just going to loan out the shares. Right now, it's still a little bit early in 13F season. But what we're looking at right here for Q1 of 2022, $2.29 million worth of AMC has been sold and only $459,000 has been bought. So there's been a net outflow from these institutions so far. This could change when we see BlackRock, Vanguard, and Renaissance coming in with their potentially large purchases if they want to average down. But if we are seeing some of these institutions offloading their position, that could be another way this selling volume is coming in to try to push the price down. Again, if a lot of these institutions were loaning out shares and then they wanted to go sell them, they are going to have to recall those shares on loan, meaning they're going to force the buying of those shorts that they've loaned the shares to, return the shares, then those institutions can sell them. Now, the other thing is through the options market. Now, we've seen this a lot in the past where the market makers are flooding the market with short exempts. They are really, really kind of maneuvering in a certain way where, especially when we saw that halt, where a lot of those options had just been added, those 50-cent increments. And we were talking about this in the morning before that halt, that most likely we were going to see a run-up. They were going to entice people to buy those contracts, then sell it off. The market makers could be behind this as well, creating all of those short exempts, recycling them over and over so they're not really showing up in a lot of this short interest data. That is another way that you could see that average days on loan start to really rocket up without really seeing a lot of impact. So that is mainly going to wrap up this update on AMC. If you guys enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So I hope you guys are having a great evening, and I'll see you guys in the next one.